Welcome to Chain Bureau, smart crypto insights for smart investors. You know, we've all been there. You hit withdraw on your crypto exchange, you're ready to move your assets, and then just nothing. That excitement, it just turns into anxiety, right? Well, in this explainer, we're going to dig into the invisible hurdles of crypto withdrawals. We'll break down exactly why your funds get stuck and how you can navigate that whole maze. Ah, yes, the question that sends a shiver down the spine of pretty much any crypto user. You see that pending status, and suddenly the minutes start to feel like hours. You're thinking, is it lost? Did I do something wrong? Look, this is one of the most common and frankly frustrating experiences in crypto. But the good news is there are usually some pretty clear reasons behind the delay. So here's our game plan for today. First, we're going to talk about the withdrawal trap, that horrible feeling of being stuck. Then we'll dive in and diagnose the most common digital delays. After that, we'll look at a real-world case study on how to off-ramp let's say, a tricky token. And finally, we'll tackle that last unavoidable hurdle, taxes. Okay, let's start with that feeling, that all-too-familiar feeling. You've checked the address maybe a dozen times. You've confirmed the transaction, but your withdrawal is just sitting there. It's almost mocking you with its pending status. This limbo state is what we're calling the withdrawal trap. And trust me, understanding it is the first step to avoiding it. All right, let's move from the feeling of frustration to the actual facts. What are the real technical and procedural reasons your withdrawal might be failing? We're about to break down the most frequent culprits so you can learn to troubleshoot like a pro. So what's really striking here is just how many of these issues are totally preventable. According to a guide from HolaX, the top reasons for failure range from really simple user errors like, incomplete KYC or just using the wrong address, to bigger external factors like network congestion or an exchange pausing wallets for maintenance. And this right here, this illustrates one of the absolute most dangerous pitfalls, selecting the wrong network. You got to think of it like trying to send a package via FedEx to a post office box that only accepts UPS. It's just not going to work. Sending an ERC20 token, which lives on the Ethereum network, to a Binance Smart Chain or BSC address will almost certainly result in your funds just disappearing into the void, forever. It's a really costly mistake that can catch even experienced users off guard. So the crucial point is this: prevention is your best defense. This quote from HolaX really sums it up perfectly. Before you even think about hitting that confirm button, you have to triple-check the address and, just as importantly, verify that both the sending and the receiving wallet support the exact same blockchain network. Two other common gatekeepers you'll run into are limits and minimums. Exchanges like Coinbase, for example, they set a daily withdrawal limit, say $50,000, and they do that to protect their own liquidity from a sudden rush. Then on the other end of the spectrum, there's a minimum amount required for a transaction to even be processed. For Bitcoin on Coinbase, that's just 0.00001 BTC. Navigating these kinds of market rules is key, and if you'd like to get 24/7 access to 5+ powerful trading indicators that predict any trading market with up to 93% wins and works on any device, you should check out the link in the bio. So now that we've covered the common problems, let's look at a more complex scenario: withdrawing some obscure token that has very little trading volume. For this, we're going to use BCOIN, the token from the game Bomb Crypto, to really explore the complexities of trying to cash out a low-liquidity asset. And this number right here, this tells you everything you need to know about the challenge ahead. With a market cap of under $500,000, Bcoin has what experts would call precarious liquidity. What does that mean? It just means there aren't many buyers or sellers, so trying to sell a large amount all at once could literally crash the price. You have to be super strategic. Cashing out something like Bcoin isn't a single transaction. It's more like a 4-phase operation. First, you have to get the tokens out of the game itself. Then you transfer them on-chain. But the crucial step is swapping Bcoin for a more common asset, like BNB or a stablecoin, on a decentralized exchange. Only then can you send that new, more liquid asset to a major exchange to finally convert it into dollars. And hey, this isn't just some theoretical protocol. This quote from a Reddit user shows that traders out there in the wild are piecing together these complex, multi-step withdrawal paths every single day. Yeah, it's frustrating, but a lot of the time it's the only way to successfully off-ramp from these smaller projects. Dealing with these complex routes requires a sharp eye on the market, which is why having the right tools is so essential. If you want to get 24/7 access to 5+ powerful trading indicators that can give you a real edge, remember to check out the link in our bio.
So you've done it. You've navigated the KYC, the network selection, the liquidity swaps, and the withdrawal limits. Your money is finally in your bank account. You're done, right? Not quite. Now it's time to meet the final and most patient hurdle of them all, the taxman.
See, in the eyes of the IRS, your crypto is not currency like the US dollar. It's treated as property, just like a stock or a piece of real estate. This single distinction, which was laid out in a notice way back in 2014, is the foundation for all crypto taxation in the US. It means every time you sell, trade, or even spend your crypto, you're triggering a taxable event.
This slide really clarifies what the IRS actually cares about. Selling for cash? That's taxable. Exchanging Bitcoin for Ethereum? Also taxable. Even buying a coffee with crypto is technically a taxable event. But just buying and holding, what we all call hodling, is not. And neither is moving crypto between two wallets that you own. Understanding this distinction is absolutely fundamental. And when you sell matters. It matters immensely. If you sell an asset you've held for a year or less, that's a short-term gain, and it gets taxed at your regular, often pretty high, income tax rate. But if you hold for more than a year, it becomes a long-term capital gain, and that comes with much more favorable rates, even 0% for some income brackets. This difference can save you a serious amount of money. And just in case you thought you could, just fly under the radar, think again. The IRS has put this exact question right on the front page of the main tax form, the 1040. You are now required by law to declare your crypto activity. Staying on top of every single taxable event requires some diligent tracking. For serious traders, having tools that help manage a portfolio is crucial. So if you'd like to get 24/7 access to 5+ powerful trading indicators, check out that link in the bio. So from network congestion to liquidity traps all the way to capital gains, the path from a digital asset to actual cash in your hand is filled with hurdles. And it leaves us with a pretty big question for the future. As this technology matures and regulation evolves, will these challenges smooth out for the average user? Or are we just trading one set of complexities for a whole new one? That's definitely something for all of us to watch. Thanks for joining us.